Hey, it is 12 noon on Wednesday, which means it's time for this week's episode of Ask the Instructor. I'm John Chrismo. The show is brought to you by the Tampa School of Real Estate, and today we're going to be talking about how to come up with investment value of a property. This is specifically important for cash flowing and rental types of investment property, how to determine the value because it is different than market value. So stick with us. We've got a great episode for you today. I'm John Chrismo. You're watching Ask the Instructor.
You are watching
Ask the Instructor every Wednesday at 12 noon Eastern Time. I'm John Chrismo. You're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Chrismo. The show is brought to you by the Tampa School of Real Estate. If you're interested in starting or enhancing your career in real estate, make sure you check out the links and the phone number below. We have advisors standing by to answer any questions you have and assist you in any way that they can. This episode, this show, this series of videos that we do every Wednesday, 12 noon Eastern Time, without fail, every week since we started these back in, I think it was like around November, December of last year. We've been coming to you live every Wednesday at 12 noon Eastern Time, and we started this off as a way to help our students get a better, deeper understanding of these concepts that are taught in the course as well as concepts you're going to use in the real world. It's a big misconception and a terrible myth that the information you're learning in the pre-licensing course isn't information you're going to use in the real world. That couldn't be less true. There's going to be things that aren't going to come up in your daily course of business just because the real estate industry has such a wide scope and so many different things, but I guarantee you there's going to be stuff you learned in your pre-licensing course that's going to come up in your normal course of business. Sometimes more so than others, especially if you're working with investors. I guarantee you're going to have to utilize what's called the income capitalization approach. So the income capitalization approach is designed to help you estimate the value of a property using the rental income that's being generated off of it. And This is a concept that's not only taught in the course, but important for your exam. And again, if you're working with investors in the real world, you absolutely want to know and understand what income capitalization is. And it's a pretty basic calculation when you know how it is to work with it. Pretty much all the math, really all the math that you're doing in real estate as well as in the real estate licensing course, it's all basic math. It's just a matter of remembering how to work with the numbers and what steps you have to work them with. Now, this income capitalization approach, this can be complicated, and there's a lot to it. And the way I like to kind of visualize this is kind of like as an hourglass. So this little hourglass that we've got here, we're going to basically break it up into our different types of income, and then how to turn that income into value. The top half of the hourglass is going to be our different types of income, and you see that we're going to basically be funneling down, narrowing down our different type of income to get to the right kind of income, and then once we have the right kind of income, we'll be able to plug that into the bottom part of this hourglass. So this kind of hybrid diagram formula thing that we've got going on here is really useful and effective for not only visualizing this material, but also making it a little bit easier to remember. So working through this hourglass, we've got our 3 different types of income. And that's going to be what's kind of boiling down. We're basically narrowing down this income to the right kind of income. The right kind of income, just to kind of skip ahead a little bit of what we need to have, is NOI. That's ultimately the type of income that we want to get to. Not only for our calculations, but also this is the type of income that's going to be most important to an investor. These other 2 types of income, they're definitely still something you want to look at, but the NOI, when it's done correctly, when it's calculated accurately, will tell you what the operating income, the net operating income, which is basically our income on the property after expenses. We're going to be diving a little bit more detail into the NOI, the net operating income, but before we do that, let's talk about these other 2 types of income. We've got, first I want to cover PGI. And with any of these acronyms, it's extremely helpful, extremely important, especially if you want to remember what these are, to not just know what this acronym is, because if you don't know what that acronym stands for, it's very easy to confuse this with these other acronyms that we have here, or these other abbreviations, really. They're not really acronyms for these ones. You want to know that PGI stands for potential gross income. So PGI stands for potential gross income. I know that might be a little bit too small for some of you guys to read online here, but that is potential gross income. Potential gross income. Reason why I'm repeating that so much, because it is important to know what these words are, because now once we know what these words are, what these abbreviations stand for, we could really break down what it is we're talking about. So first, we're talking about a type of income. The whole kind of income hourglass that we've got here. So that's pretty self-explanatory. The income, but meaning the money that's coming in off of the property. Now we also have next to that the word gross. The word gross means that we haven't extracted the expenses yet, that the expenses are still included in the number. And if you're an investor looking at a property, a gross income is a gross number. You don't want a gross literally, meaning that that's an ugly number. We don't want a gross income, because that's how much income we could have without expenses, but that'll never happen. There's always going to be expenses for any sort of property or any sort of business. So that's a gross number, because it makes you sick. It makes you sick seeing how much money you could have before the expenses come in. And that's my kind of crazy rationale as to why they call it gross. Whether or not that's the real reason they started calling it gross income is a different story, but it is a really good effective memory tool. Remember, as an investor, that's a gross number, because that's not reality. That's not how much you're getting after the expenses. That's where our net income is going to come in. Now, the last word we've got here is potential. The potential meaning what could happen, what this property has potential to gross, to generate in income. So the example I like to use, just to keep things simple, is let's say we've got a 4-unit property. We've got this 4-unit property, quadplex, and let's say that each one of these units will rent out for $1,000 a month. We're the listing agent on this property, and we see this 4-unit property, and we're like, okay, it's completely vacant now, which isn't a good sign in the investment world, but it could mean that there is opportunity in there, and maybe there's another reason why it's not rented, but it does make your job more difficult in trying to understand and concoct to come up with the value off of this. But let's say we're looking at this property, we're the listing agent, or maybe we're talking to an investor, we're trying to do these calculations for them. There's a lot of different contexts that you could do this calculation with. And we say, okay, each one of these 4 units, they're all equivalent units. They might be different in the real world. You might have one 1,500, 1,200, 1,100, 900. Who knows? They might be different amounts, because maybe this one's nicer, this one's bigger, whatever it may be. But we're just going to have a simple scenario here. Each one's renting out for $1,000 a month. Now, the thing you want to remember with income is always assumed to be annual. And if it doesn't specify otherwise, you're usually going to be dealing with an annual number. When you're dealing with rent, however, rent is always assumed to be a monthly number. And it most often is a monthly number. Your rent would be monthly, your income would be annual, again, unless it does say otherwise. And that's also an important tip to know for your Florida real estate exam. So we've got these 4 different properties, or these 4 units within this one property. We could generate off of this $1,000, $2,000, $3,000, and $4,000 a month. So this property as a potential to generate, a potential to gross $4,000 a month, because we have 4 units, they could each rent out for $1,000. But remember, we need to now convert this from a monthly number, because this is $1,000 a month for each unit, to an annual number when we're dealing with the income here. So when we go ahead and figure that all out, our potential gross income on this property ends up being $4,000 times 12 months, because we've got 12 months in a year, $4,000 a month, so that's going to give us $48,000 of potential gross income. So this 4-unit property, if it's a perfect world, and we're renting every single unit every single month, and we don't have any vacancy or collection losses, I mean, everyone's paying on time, we don't have a unit sitting vacant for any period of time, as soon as one comes available, it's instantly rented, it's already having a new tenant in there, in that perfect world, and you can also think of that for the P there, perfect, or really potential, what we could generate is $48,000 a year. So we're off to a good start here, especially when you're looking at a vacant property. That's a good number to know, the potential gross income, because that's going to help you understand what that highest peak would be. In the best case scenario, this is how much you could get out of that property, that you could generate from that property. And it's good to know that number, because then you know really the maximum. If we eliminated all expenses, if we eliminated vacancy, if we eliminated collection losses, people not paying on time, that's what we'd be looking at as the absolute maximum. So it is a number that'll help you understand the property a little bit better, but it's not our end-all be-all, because it's not a perfect world. We're not always going to have the property rented. We're going to have delays in collection and fees and things like that. There could even be, maybe we've got a vending machine or a laundromat on the property, and that could be another source of revenue. So you'll have these things that might decrease it, things that might increase it as well. But when you're looking at potential gross income, that's okay, what's the potential from these properties it is that we're looking at here? So that's our PGI. Now, again, it's not a perfect world. So how do we get to a calculation assuming reality? Assuming the reality that we're not always going to have this property rented. We're not always going to have this property with every single tenant paying on time. They're not going to be perfect tenants. So that brings us down to what's called effective gross income. So EGI, or effective gross income, keyword you want to know here is effective. That's really the only word it is that we're changing from potential. And again, if you understand what this abbreviation stands for, potential gross income and effective gross income, we're still dealing with a gross income, so we still know that this number, remember, gross means we haven't removed expenses. Expenses are still factored in on this deal. So we know that the expenses are still in there. But now what are we changing here from potential to effective? Well, when we say effective, we're basically meaning what's really going on. How much money is really coming into the property? How much we are really generating after vacancy and collection losses. So that's going to be what you're subtracting to go from this level down to this level here, is vacancy and collection losses. And now this number, because you might ask now, okay, well, what is the amount that we're going to lose for vacancy and collection losses? A smaller property like this, comparatively speaking with a larger property, a smaller property is typically going to have a higher percentage of vacancy and collection losses compared to a larger property. In the larger property, it typically tends to have a little bit better management. They've got more product to actually sell out there, so they might attract more people that way. In reality, it could go either way, but typically with a smaller property, the norm, the average tends to be that we have a higher vacancy and collection loss for this. And when you're trying to establish value for a property, or really get an accurate read on these numbers, maybe you're looking at this property and this property hasn't been built yet. You haven't built this 4-unit quadplex yet, or maybe it's vacant and you have no idea basically of what the NOI could actually potentially be. That's another reason you might use this formula and this calculation here to try to figure some of these things out. So we figured out what we could generate, what the potential is in a perfect world, but now we have to subtract out some money for our vacancy and collection losses. So to figure out what this percentage would be, how much that would typically make up, you want to do a market analysis and try to find out in your particular market what type of vacancy and collection losses are going to be average. And the best way to kind of try to find that data is looking at the data of other properties that are maybe on the market. And what you also want to look at too, and this is why it's important to understand how this is calculated, maybe this property is already being marketed and it already has tenants in it and they're advertising this certain percentage of vacancy and collection losses. Well, now how do you figure that out? You want to basically take the rent money that was generated for the last 12 months, how much rent money actually came in, and divide that out of the potential rent money based on the rate of rent it is that we're being charged in each one of these units at that over the last 12 months. What was the effective gross divided by the potential gross? And that's going to give you some sort of percentage. Or you could also do the calculation of the money that was left on the table, how much vacancy and collection loss expense we had. Take that number and divide it by your potential gross income. But what you want to find out is make an estimation of what that percentage is going to look like. How much of this $48,000, what percent of that are we going to lose to vacancy and collection losses? So what we're going to do for this case here, since this is a smaller property, it could be more than this, it could be less than this, but we're just going to go ahead and pick a 10% number for this. We're going to pick 10% vacancy and collection losses to figure out what our effective gross income is. But before we get any further, we're going to take a quick commercial break, so stick with us. I'm John Carismo. You're watching Ask the Instructor.
Have you been thinking about starting a career in real estate? Enjoy an entrepreneurial lifestyle that allows for schedule flexibility with unlimited income potential. In real estate, the sky is the limit, and what you put in is what you get out. Learn more about a career in real estate at tampaschool.com. Did you know that if post-licensing education isn't completed by your first renewal, your real estate license will become null and void? If your license becomes null and void, you must restart the licensing process all over again. At the Tampa School of Real Estate, we make renewal requirements easy. Visit postflorida.com to learn more and enroll today. Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com.
Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm John Carismo. You're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Carismo. This show is brought to you by the Tampa School of Real Estate. If you're interested in starting or enhancing your real estate career, make sure you give us a call at the phone number below. Our advisors are standing by to answer any questions you have and assist you in any way it is that they can. Phone number is 813-928-0106. You can also check out tampaschool.com. That's tampaschool.com for all of your real estate education needs, including our strategy to help you pass your exam on the first try, and that's also at passfirsttry.com. So make sure you check those out after the show. But let's just jump back into understanding this income capitalization approach to determining the value of the property. So before we went on break, we started giving a little bit of an outline of an understanding of these different levels of income that we have. We started off with the potential gross income. This is how much our property could potentially generate over a certain period. Typically, this is an annual number. Always, again, assume that your income is an annual number. So this is how much potential we can make, which with this 4-unit property, this little real-world example we're throwing in here, that could be $48,000 that this property could potentially generate. But we have to live in the real world. And in reality, we're not going to have the property rented out 100% of the time. We're going to have collection losses. We're going to have tenants that get behind on the rent that we have to evict. And we don't make money during that process. We lose money. That's our vacancy and collection losses. And really, when we start having to pay attorneys and things like that, that could make that number even higher. Maybe you're taking that into account under the NOI. Really, the collection losses probably should go up here, but kind of depends with this. And that's the beauty of understanding this and understanding how to calculate and come up with these numbers. Because then when you're analyzing a deal, whether that's for you as an investor or you're working on behalf of an investor and helping this investor understand and analyze the deal, a lot of investors still use real estate brokerages to help them with the deal. They typically don't pay as much as a residential transaction, especially when you start getting into multi-million-dollar deals, but there's still a value there, even though they're a professional, and a lot of times this might even be their job to invest in properties. They still like the knowledge and the expertise of a brokerage involved in there. And you want to be able to understand, if you want to have a seat at that table, or even have the chance to have a seat at the table with any investor, whether they're buying a $100,000 property or a $100 million property, you want to understand these concepts, especially if they're trying to get cash flow off of the property, especially if they're getting cash flow off of the property, because this is how they figure out whether or not they're just throwing their money away. And these are the numbers that they want to analyze. And a lot of times when there's a broker or even a landlord marketing a property, these numbers might not always be accurate. Very often there's some sort of discrepancy in these numbers. There may be cooking the books, for lack of a better term, to try to make the property more attractive. So being able to understand this calculation is super important. And this is information that's taught in the pre-licensing course. So just go to show you that this is stuff really going on out in the real estate world that you learn about in there. And this is testable on your exam. It's really good stuff to know for your Florida real estate licensing exams. But again, you don't want to just... It's one thing to just know what these numbers are. The second thing, and the more important thing, is knowing how to calculate out these numbers. So you could go back and fact check them to find out, are they really telling the truth? Is this really how much money we could expect to net on the next 12 months of this property? So before we went on break, we started talking about the vacancy and collection losses. And again, that vacancy and collection loss, that's going to be the money that we're not able to take out of the property, because this is money from either vacancies or collections. So we're going to take that $48,000, and what we're going to do is just multiply this by 90%. So if we just punch that in our calculator, $48,000 by 90%. And the way I'm coming up with that number there is because 10% plus 90% equals our 100%. So what's left over for our effective gross income is $43,200. $43,200. So our potential gross, this is fantasy land. This one we're getting a little bit closer to reality because we factored out the money that we're not going to be collecting, because it isn't a perfect world. But now we still need to go down to our net operating income. And again, you want to understand what these words mean, so it'll help you remember what we're talking about. So our net operating income, that word net, this is the opposite really of gross. Gross means expenses are included in the number, so we never took expenses out up here. We took out losses, but that's not really an expense because we never had that money coming in with the vacancy and collection losses. Now when we get down to the net income though, you want to remember net is not expenses. You just turn net into not, just N-E-T to N-O-T. You're just really closing up the E there, especially if you write sloppy like me and you can't really tell it's an E, and just close that up. It's not expenses. So our net income does not include expenses. So for our net operating income, what type of expenses is it? It's not operating expenses. Not operating. That's what you want to remember for net operating income, the NOI. And that's the right kind of income, because what that is telling you is how much money, how much cash you're able to take out of this property, not including one particular type of expense, which is an expense in most cases, unless they're paying cash. So these calculations here, this income is based on paying cash for the property. This income, all three of these incomes, for what we're coming up with here, we're never factoring in financing at all. And that goes back to, let's rewind here and let's say we've got this property, this 4-unit property that we're listing for sale as a realtor, as a broker, whoever that we're marketing this property. Maybe we're just the landlord. When we market these numbers, because probably half the investors out there buying these properties don't even know how to come up with these numbers. They'll just take them for what they are. And they're just kind of, walking in blind here and letting somebody hold their hand and guide them through it. So that's why, again, it's important to know how to calculate these out. But the reason why you want to not factor in financing is because when you're marketing this for sale, you might have people that are looking to buy this property with cash. At the same time, you'll probably have a bunch of people looking at buying this property with financing. So it depends on the investor of what their financing expense may be. They may have zero financing expense if they're paying cash, but you might have somebody that has a 90% loan-to-value loan, a 20%, a 30%, 40, 50. You have all these different levels. And so rather than coming up with 20 different net operating incomes, you come up with one net operating income, one expected amount of income to be generated if you're paying cash, and then you factor in your financing on top of that. But that's important to remember, is that this net operating income does not include any financing charges, any sort of financing expenses for that. That's something important that you want to factor in for determining the cash flow of the property, but you always want to remember NOI is not going to factor in any sort of financing, so that is also important to know. So again, at this level now, we're subtracting out our operating expenses. And let's say for this 4-unit property that we're dealing with here, and now the operating expenses, it's almost anything except for our financing expenses of the property. This is going to include your property taxes. This is going to include money you're setting aside to rehab the property, the reserve for replacements, any sort of paint it is that you're doing on the property, lawn maintenance, pool maintenance, any sort of maintenance that the property requires. All that, one of the big expenses again is the property taxes. That's going to be a huge expense out of all this here. So all of those expenses directly related to the operation of the property. Maybe you have some parking lots or a dumpster that has street lights on it. Well, I mean, those street lights aren't paying for themselves. Somebody's got to pay Tampa Electric or whoever's who's billing the electricity out in the area. So all of those expenses that are directly related to the operation of the property, which again doesn't include any financing expenses, as well as any expenses that aren't related to the operation of the property. There could be a property management fee that's in there and all kinds of things like that. But then when you take out all those operating expenses, let's say in this case here, let's say it's about $20,000. So let's say it's $20,000 it costs for this property to operate it across 1 year. Because remember, all these income numbers, all the numbers we're dealing with here, except for that rent, should be in annual numbers. So what we'll do is just subtract out that $20,000, and now all of a sudden that EGI, that effective gross income, our income, our real income, the amount of income that's really coming in but still before expenses, is going to go from $43,200 to our NOI of $23,200. So our NOI on this property would be $23,200. And like I said, that's going to be how much money you could expect cash to come out of the property after 1 year. So 12 months, you pay cash for the property, you end up with $23,200. That would be your net operating income, your income after all the expenses associated with operating the property. But now that's just finding out how much money we could generate, which is important. But now what's in this bottom half of the hourglass here, this bottom triangle here, and figuring out, okay, we figured out the right kind of income. That's NOI. NOI is what we need to be shooting for here. That's our right kind of income. That's our most indicative income of how much money it is we're going to make, unless we're having financing. Then we have some other expenses in there, and then we might have income taxes that we're paying personally and other expenses like that. But for this property, that's the right kind of income we need to have. And this income, this would allow us to compare multiple properties. So maybe there's a few properties like this that we're comparing this to. Once we've done this right and we fact check this to make sure that that NOI is accurate and a realistic number in case that's not rented out currently, now we could go ahead and compare this against other properties out there. But now how do we figure out what the value is going to be for this property? We're going to cover that after this quick commercial break, so stick with us. I'm John Christmas. You're watching Ask the Instructor.
Have you been thinking about starting a career in real estate? Enjoy an entrepreneurial lifestyle that allows for schedule flexibility with unlimited income potential. In real estate, the sky is the limit, and what you put in is what you get out. Learn more about a career in real estate at tampaschool.com. Did you know that if post-licensing education isn't completed by your first renewal, your real estate license will become null and void? If your license becomes null and void, you must restart the licensing process all over again. At the Tampa School of Real Estate, we make renewal requirements easy. Visit postflorida.com to learn more and enroll today. Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com.
Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm John Chrismo. You're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Chrismo, and this show is brought to you by the Tampa School of Real Estate. If you're interested in starting or enhancing your real estate career, you need to give us a call. Phone number is 813-928-0106. Our advisors are standing by to answer any questions you have and assist you in any way it is that they can. But let's just jump right back in here because I've got a lot to cover on this income capitalization approach. So before we went on break, we covered our three different types of income: the potential gross income, the effective gross income, and the net operating income. And ultimately, the net operating income is the right kind of income. That's the income that we want to find out, because that tells us how much money we could get out of this property after expenses. And we're going to need that information to be able to work with the bottom half of this triangle here, because what we're doing in the bottom half is what's called IRV. So it's I over R times V. That's kind of the formula it is that you want to remember here. If you remember this layout, it's going to help you immensely for understanding what the formulas are for finding value of a property, finding the income of a property, or finding the rate of return or capitalization rate or cap rate of a property. So we've got this IRV triangle here. And again, these stand for income, rate, and value. So income, rate, and value are three different things that are in here. So let's say we're trying to use this hourglass, this little triangle here in the real world, and we're trying to come up with the value of the property. We've already gone through and we found this 4-unit vacant property that the landlord's saying, hey, I want you to market this property for me. And you're like, okay, we got to market the property, but we got to tell people what the NOI is on this property. Since this is a 4-unit property, that's a property people are going to want to make some money off of, because who's going to need 4 units for themselves? So you went through, you said, okay, each unit could rent out for about $1,000 a month. Therefore, annually, our potential on this property, our potential gross income is $48,000. But we need to be realistic. We've got to assume at least 10% of the time we're either going to have units vacant or we're going to have collection losses. And so we take out that 10%. So what we're left with is 90% here. That's what this EGI is of the PGI. The EGI is 90% of our PGI, our effective gross income, because effective gross income, that's what the E stands for, is how much we're effectively grossing or effectively generating, or what money is really coming in, because this is the money that we're planning on not coming in. So our effective gross income on this property would be $43,200. But now we're not out of the woods yet, because this property isn't going to operate for free unless we're in there doing all the work and somehow we have all these materials for free, which even if you are doing the work yourself, you still have to buy the things that you would need for it. But in most cases, the investor is going to pay somebody to do these things, as well as for property management and other expenses that we may have, because this is only replicatable and duplicatable if they're able to do this across multiple properties. If it relies on them being able to do all the work themselves, that's not a big-time investor there. That's somebody that's happy with just this one property and maintaining that one property. And yeah, they'll probably get close to that $43,200 number, but imagine now if they had 10 of these properties, and 10 times $23,200, $232,000 a year is a lot better, even if you're squeezing every last penny out of this property, the $43,200. So just a little tip there, just in case you're wondering about why those expenses were so high. But in this case, we estimated the expenses to be $20,000. And in the real world, you want to try to come up with an as accurate estimation as possible. So literally to where you're breaking down, okay, it's going to cost this much for the lawn, it's going to cost this much for this, it's going to cost this much for this, we're going to have to factor in some expense for this, the property management company is going to charge this. So ultimately, you have a realistic number for our operating expenses. But let's say in this case, again, the example we used was $20,000. So we're saying every year about $20,000, almost half of our effective gross income, that money's going to our operating expenses. One of the big expenses you really never get away from, even if you are managing yourself, is the property taxes, which on a property like this, I mean, that's probably going to be a few $1,000s at least a year, depending on where the property is located. So ultimately, we took out that $20,000 of operating expenses, and we're left with our net operating income, the right kind of income, because this is the income we're generating off of the property after all of our expenses are taken out here, of $23,200. So $23,200. And real quick, got a question coming in for Jatinder Bond. So Jatinder's asking, is there recordings anywhere? And absolutely there's recording. Go to tampaschool.com/success after the show, of course, so you don't miss any of this stuff here. And there's recordings of all the past episodes. You can also find them on YouTube, on Facebook. We're everywhere, so make sure you just search for it, Ask the Instructor. You'll be able to find it. Best place, though, is tampaschool.com/success. So just in case any of you guys are tuning in now and you're kind of wondering what it is that we're talking about here and how we got to this point and how we broke down all these numbers there, tampaschool.com/success is the best place to find that. But now let's get into this bottom half, because everything I've explained so far is just getting to the right kind of income. Now, we're the agent. Again, that's our scenario we're dealing with here. We're trying to find out how much we should sell this 4-unit property for that could generate $23,200 a year in net operating income based on our estimates and figures we've came up with here. So what we're looking for, and this is where you use this IRV triangle, the bottom half of this hourglass here, is you circle what you're looking for. We're looking for the value, and what we're left with is income over rate. So that's what remains with it here. And that basically means that our formula is value equals income over rate. You circle what you're looking for. We're looking for the value. Our formula is I, the income, over R, the rate of return. So I over R. Now, the question is, what are we going to... What's the rate? Because we're trying to find the value. That's what we're solving for. We figured out the net operating income, and that's why we have this hourglass design here, because that's our right kind of income. That's the right type of income we need to get to. So what we're going to do is look at the market. We're going to study the market and try to determine what's the going capitalization rate. And you might have to do this math across a couple properties to get an understanding of what that cap rate is, what rate of return. Or you could look at this a different angle. Maybe you're dealing with this for a particular investor, and that investor says, I want to get a 10% return on my money. That means that they want this money that they're getting off of the first year. If they're paying cash on this property, they want this to be 10% of the money it is that they have invested on that property. And that's going to be our cap rate, our capitalization rate. And we're just going to keep the number simple here for this problem here, because that'll help you understand this a little bit better. So what we're going to do is going to copy down that formula. Value equals, we've got our income. Again, it's annual net operating income that you need to work with here. So we've got our income of $23,200. We're just going to simply divide that by the rate of return. It's either the market rate of return, the market cap rate, or the rate of return that the investor is looking for. And we're going to say that's 10%. Now, if you're putting that in your calculator, you need to make sure you put it in there as a decimal. And basically what we're doing is $23,200 divided by 10%. So $23,200 is 10% of what? Well, you punch that in your calculator, it's going to do the math for you. That $23,200 is 10% of $232,000. So the value on this property, assuming a 10% cap rate, a 10% capitalization rate, is $232,000. That would be the value that we could come up with here. So like I said, this is very useful if you're an agent or a brokerage listing this investment property for sale, because now you've got a number that you could put out there and market. Okay, this property, we've got it listed for $232,000. The reason why it's $232,000 is because we're assuming a 10% cap rate on a net annual income of $23,200. And there you now have a value. And that's kind of the practical way of working through this, of how you may come across this. If you're an investor yourself trying to sell a property, or you're working on behalf of an investor helping them sell their property, you need to be able to know how to do this math, because people are going to be looking for these numbers. That's what they're using to judge and gauge your property. And if they're doing it right, they should be doing that initially and then getting the documentation so they could do these calculations themselves. In case you ever see the wording pro forma, the word pro forma basically just means that, hey, this is an estimate. This isn't based on any actual numbers. This is a vacant property. And that's what we just did here. We just did a pro forma. That's, again, what that wording is, pro forma estimate of the value of the property using pro forma numbers. We're assuming, okay, that 10% is the average for the market, that $20,000 in operating expenses is the average for the market, that the average for the market rate of return is a 10% cap rate. And based on all that information, okay, this is the value it is that we came up with here. But now the other ways you might use some of these numbers, there's a few different ways, but you might be using this to get a bearing. Maybe you're working with an investor, or you're the investor yourself and you're trying to gauge this property of what it looks like to you, and maybe they haven't done all this legwork and math and made it easy for you to at least get that initial gauge on it here. The other thing we could be potentially looking for is, okay, what is the rate of return we could expect on this property? So what you do is you circle rate, what's the cap rate on this property? You're going to take the income and divide that by value. So our rate, the formula for that, rate equals income divided by value. And now once you figure out what all three of these numbers are, the $23,200, the 10%, and $232,000, they're all going to check out. These numbers aren't going to change at all once you found all three of them, unless you're changing some of these numbers. So if you say, okay, I want a 12% rate of return, okay, now what's my value of the property? What would the price I should pay on this if I want a 12% rate of return? Because that number is now going to go down, because that's still the income that we're getting on the property. So there's a lot of ways you can play with these numbers and work with them, and that's going to be the benefit of working with these a lot. And that's why before you start working with an investor, if you've got an investor lead, that lead, it could be worth so much money, but only if you don't screw things up. If you go in there not knowing what you're doing, you haven't practiced any of this information, and you guys should know all this stuff, because this is stuff that's definitely taught in the pre-licensing course. So if you have a real estate license, you should definitely know this. You're expected to know this. That's why they make it part of the course. So you should definitely know this, and you should know it in depth if you want to work with an investor. Do some of these calculations on your own so you can realize how it is you have to play with these numbers. You shouldn't even have to think about it, that if the capitalization rate goes up, our value is going to have to go down, or our income is going to have to go up. There's only one way, or two ways really, to increase that rate, is either making your income higher or making the value lower. That's the only way to get that higher rate of return. The more you play with these numbers, the better you're going to understand that and how these kind of all work with each other. But basically our formula, what that would look like, if let's say we didn't know what that capitalization rate is, all we're going to do is just plug in our numbers. We've got our $23,200. Again, you always want to use NOI. You always want to use annual net operating income. That's the right kind of income to be working with this IRV triangle. So you take that $23,200, and now we're going to divide it by the value. And let's say the asking price on this property is $232,000. We go ahead and divide that by $232,000, and we're going to get 10%. So if we paid $232,000 for this property and we get $23,200 worth of income, our rate of return for this property is going to be 10%. But now what would happen if we've got a different asking price for the property and we're trying to negotiate and things like that? We're going to cover that after this short commercial break, so stick with us. I'm John Chrismo. You're watching Ask the Instructor.
Have you been thinking about starting a career in real estate? Enjoy an entrepreneurial lifestyle that allows for schedule flexibility with unlimited income potential. In real estate, the sky is the limit, and what you put in is what you get out. Learn more about a career in real estate at tampaschool.com. Did you know that if post-licensing education isn't completed by your first renewal, your real estate license will become null and void? If your license becomes null and void, you must restart the licensing process all over again. At the Tampa School of Real Estate, we make renewal requirements easy. Visit postflorida.com to learn more and enroll today. Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com.
Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm John Chrismo. You're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Chrisman. The show is brought to you by the Tampa School of Real Estate. If you're interested in starting or enhancing your real estate career, make sure you give us a call. Phone number is 813-928-0106. You can also check us out at tampaschool.com. And what we do every Wednesday at 12 noon Eastern Time is come to you live into your homes, into your phones, into your tablets, your small screens, your big screens, to help you understand these more complexities of the real estate industry. And what we've been talking about today is the income capitalization approach. And this is one of the ways you could use to determine the value of the property. And what we've done so far is we figured out just that. We've done a lot of math here. We've worked with a lot of different numbers, but these are very real world numbers, especially if you're an investor or you're working with an investor that's looking to pick up some rental properties. These are numbers and calculations. You want to know what they mean, how to calculate them. You want to know these inside and out, because there's one thing that's going to make you look bad as an investor or to your investor clients, and that's making a miscalculation, or just basically taking this net operating income that's being advertised as the real legitimate net operating income because you don't know how to figure out net operating income, or you don't know how that figures out into value and whatnot. This is just very basic information, but it's absolutely essential anytime you're investing or working with investors in real estate. Now, we've really only got one more calculation to do, and that's how to figure out the income when we have a capitalization rate and a value on a property. But before we went on break, I mentioned, okay, a 10% rate of return on a $232,000 property when we're getting $23,200 worth of income. If that's our annual net income, that's our value, that means we would get a 10% rate of return. But now let's say we don't want a 10% rate of return. We want a 12% rate of return. What should we pay for this property to get a 12% rate of return? So to find that out, if we're again we're saying, okay, what should we pay? Now it's another value calculation. What's the value when we have this income and this rate of return? So our income, that number's not changing. Not yet, at least. We'll do a calculation real quick on changing that in a second. But let's say we've got that $23,200 worth of income. Let's say the income is what it is, and we're not planning on raising rents or doing anything like that, and that's our income. All we're going to do is just take the income and divide that by the capitalization rate. So over here we did 10%. We came up with a value of $232,000. And let's say that's what they're asking for this property. But say we want a 12% return on investment. What should we offer on this property so we can get a 12% return on investment? So we take that $232,000, and now what we're going to do is divide this by 12%. So we're going to take $232,000 divided by 0.12. That's 12% as a decimal. Make sure you don't have fat fingers and hit the wrong number on your calculator. 23,200. Can't read my own writing. Divided by 12%. And we should end up with $193,333. I knew 19 million seemed a little high. So we should pay just a little bit short of $194,000, and then we're going to be able to get a 12% return on our investment. And now that's a big difference that we're paying in the value of the property here. I mean, we cut out almost a fifth, if not a quarter, of the value of the property at this new rate to get that extra 2% bump, to go from a 10% to a 12%. At 10%, we could pay $232,000 for a property and get a 10% return on our money. But if we want to bump that up to a 12%, now we're having to pay $193,333. So it's important to understand the relationship of these numbers to know that, okay, if we're going to keep the same income, but we want to make a higher return on investment, that value is going to have to go down. And now there's one other way we could work with these numbers here, and that's for finding our income. So let's say we want to figure out the income on a property. We say we didn't have this $23,200 number, because if you're trying to find the income, then you wouldn't have that. Or maybe you're just trying to fact check the numbers it is that they gave you. So what you do is you circle what you're looking for, and then what you're left with is your formula. So in this case, our income is rate times the value. So rate times the value equals our income. And so let's say that we're negotiating this deal. So we're trying to negotiate this out, and we want to get a 12% return on our investment. We already established that. The asking price on this property is $232,000, and we made our $193,000 offer, but they didn't budge. They laughed at our offer. They were insulted by our offer. So now we have to figure, okay, to get that extra 2% bump, what do we have to increase that NOI to? How much are we going to have to increase the rents, and so on and so forth to understand what income we need to get that 12% rate on return. So basically, all we're going to be doing is just plugging in our numbers here. The rate, again, we're looking for a 12% rate of return times the value of $232,000. So when we plug that in our calculator, 12%, 0.12 times $232,000, we end up with $27,840. So $27,840 would be how much NOI we really need. So we got to basically trim that NOI. We got to somehow generate an extra $4,000 a year. We'll figure out the exact number. So let's figure out exactly. It should be about $4,000. So $27,840 minus $23,200. That brings us down to $4,640. So just a little bit over $4,000 that we need to squeeze out of this property somehow in order to get that 12% rate of return. And these are good calculations to do, because this helps you understand your more long-term strategy on the property to, okay, when we're moving forward and looking ahead here, okay, we're going to buy it at a 10% cap rate, but now what do we have to do to the income to push it to a 12% cap rate? Well, that's increase it by $4,640 a year. But then we also have to factor in our vacancy and collection losses. So if we're assuming that 10% number is accurate, it really wouldn't be this much potential gross income, aka this much rent we need to factor in per year. That number is 90% of the number it is that we need. So we're going to go ahead and hit divided by of the 4,640 divided by 0.9, and then we get $5,155 and about 56 cents or so when you're rounding. So we're going to need about $5,155 of extra potential gross income to end up getting that extra $4,000 or whatever it was that we needed to get our 12% rate of return. And now we can figure out, okay, we're dealing with 4 units here. Let's divide this across each of the units. So on 4 units, that's an extra $1,031 a year. We divide that out by 12 months. And all that is an $85 rent increase. So you increase your rent $85 instead of $1,000, $1,085. Or who knows, if you want to be more conservative on this, you can do $1,095 or just do $1,100. So really all you need, though, is the extra $85 that's going to factor in your vacancy and collection losses. Now that's going to also assume that we don't have any additional expenses by increasing this rent, the extra $85, which for a small bump like that, $1,000 to $1,085, you won't. But by doing that extra $85 a month on each one of these, we're going to be able to boost our NOI to $27,840, which will give us a 12% rate of return on the property that we paid $232,000. So like I said, it's important that you understand in depth how to work with these numbers, how to backtrack through them, just like I did there, because that's where you can be the beacon of light, the person who knows, the understander, and that's what your job as the professional advising an investor here, because maybe you guys make the offer of that $193,000, and that's probably what even a basic agent would be able to figure that out. Okay, you want a 12% return, then we'll have to pay $193,000. They reject your offer, and it's like, I don't know, you raise the rents. Well, how much do I have to raise the rent? So I don't know. Well, that doesn't even sound like a good deal. But if you could show them that, hey, all we got to do is raise the rents on each one of these 4 units by $85, and that's going to bump us up to our 12% rate of return and still cover our 10% vacancy and collection losses. That's all we need to do. We'll pay their asking price, but then we're going to turn around and raise the rents. And in this type of rental market it is that we're in right now, that's very possible something that you could do. You could absolutely do that. It's an $85 rent increase. It's not like you're asking for the moon with that. Yes, it is a rent increase, and you might have to increase your operating expenses on that. And again, you want to run these numbers here to understand the feasibility and how realistic these calculations is that you're coming up with here. Even if they've already given you all this information, I challenge you to fact check it. Every deal, whether you're an investor or you're working on behalf of an investor, you got to fact check this information that's out there to find out, okay, is this stuff real? Is this stuff legitimate? If we're having numbers like this where everything ends in 3 zeros like that, $20,000, what if somebody tells you the operating expenses on the property are about $20,000, they're probably making up that number. If it says on paper that it's $20,000, I almost guarantee you they're making up that number, that's not an accurate representation of the expenses, because how do you end up with exactly $20,000 in operating expenses? You don't. If you're using estimations like that, then okay, you'll probably see numbers along those lines, but just know that that's just them picking a number out of the air rather than coming up with an accurate estimation of really adding together what these expenses equal up to. So that's why you want to understand how to calculate this out, not only if you're the listing agent marketing this property so you figure this out, or if you're an investor, but also on the buying side of this to fact check this information, to understand how you work with these numbers, to how much rent you have to increase on the property to bump us up to that extra 2% cap rate, that extra to go to 12% instead of just a 10% if we can't get them to budge on the price, or maybe we pay them full price and then what do we have to do here, or some combination of the both. There's so many different ways you could rearrange and work with these numbers to find that happy medium that makes everyone happy. Not too much of a rent increase for the tenants, you're still getting close to the value that's being charged. Maybe you're able to go through and look through these expenses and trim some fat there to make that a better understanding of what the value is. But there's just so many ways to work with these numbers. You really have to know what it is that you're doing. And that's why we've got this nice little hourglass, this nice little funnel here that shows you how this all kind of feeds one into the other and makes it a little bit more visual, and hopefully that's helped you guys understand it. I'm sure that this is something, especially if you're working with an investor picking up rental properties, that you could use in your business. Again, that's why it's taught in the pre-licensing course. This is all stuff that could be up on your exam. Maybe not as in depth as we got with this at the end, but it could be, especially for the broker exam. So if you guys want to watch the whole episode again, you could do that, and I'm going to let you guys do that for free, as well as all of our previous episodes. Just go to tampaschool.com/success. tampaschool.com/success. You drop your email in there. Not only will you get notified of any future episodes it is that we're streaming live, you'll also get access to all the recorded episodes that we have of this, including this one here. And on our Success Center, you're able to slow it down, speed it up, and all that, pause it, play it, watch it as many times as you need to fully understand that. That's our gift to you from the Tampa School of Real Estate. Make sure, again, you check that out, tampaschool.com/success. 2 S's, 2 C's in success, SUCCESS. But tampaschool.com/success. Or if you need help with that or any help with anything in the real estate career, give us a call. Phone number is 813-928-0106. Our advisors are standing by to answer any questions you have and assist you in any way it is that they can. I hope you guys have enjoyed today's show. Make sure you tune in Friday for State of Real Estate. That's also at 12 noon, as well as next Wednesday, for next week's episode of Ask the Instructor. I'm John Chrismo, and I will see you soon.
Have you been thinking about starting a career in real estate? Enjoy an entrepreneurial lifestyle that allows for schedule flexibility with unlimited income potential. In real estate, the sky is the limit, and what you put in is what you get out. Learn more about a career in real estate at tampaschool.com. Did you know that if post-licensing education isn't completed by your first renewal, your real estate license will become null and void? If your license becomes null and void, you must restart the licensing process all over again. At the Tampa School of Real Estate, we make renewal requirements easy. Visit postflorida.com to learn more and enroll today. Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com.
you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm John Chrismo. You're watching Ask the Instructor.